Before we dive in, a quick but important note. I am not a licensed financial advisor, and this presentation is for educational and informational purposes only. The information in this video is not intended to be a substitute for professional financial advice. You should always consult with a qualified professional before making any decisions about your personal finances. Your mortgage is a significant legal and financial commitment, so treat it with the seriousness it deserves. Alright, let's talk about that piece of mail. You know the one. It arrives like clockwork every single month, either in your physical mailbox or as a PDF in your inbox. It's from your mortgage lender. You open it, your eyes scan for two numbers, the amount due and the due date. You see them, you log in, you make the payment, and you file the statement away, never to be thought of again. If that sounds familiar, you are not alone. A recent study revealed a staggering fact. Nearly half of all American homeowners admit they do not fully understand the details on their mortgage statement. Half. That's tens of millions of people making the single largest payment of their month on the single largest asset of their lives, with their fingers crossed, hoping everything is correct. But what if I told you that ignoring the fine print on that statement is one of the costliest financial mistakes you can make? What if I told you that buried inside that wall of text and numbers are clues, warnings, and opportunities? That one tiny, overlooked line item could be a signal that you're overpaying by hundreds of dollars a year? Or that another could be the key to paying off your house 5, 7, even 10 years early? Your mortgage statement isn't just a bill. It's a monthly report card on your journey to building wealth. It's the story of your home, and it's time you learned how to read it. My promise to you is simple. By the end of our time together, you will no longer feel intimidated or confused by this document. You will master it. You will be able to look at any mortgage statement from any lender in the United States and know, with absolute confidence, exactly where every single penny of your payment is going. You'll learn how to spot common, costly errors in things like escrow accounts. You'll understand the critical difference between principal and interest, and why that difference changes dramatically over time. You'll finally know what PMI is and, more importantly, how to get rid of it. We are going to demystify the jargon, cut through the complexity, and give you the power to take control of your biggest financial obligation. This isn't for finance nerds or math whizzes. This is for every single person with a mortgage who wants to be smarter with their money and more secure in their future. Think about it. For most of us, our home is more than just a place to live. It's the foundation of our financial lives. It's our nest egg, our forced savings account, our legacy. And the mortgage is the engine driving it. Understanding how that engine works isn't just a nice-to-have skill. It's essential. I once spoke to a homeowner who, for 2 full years, was paying for private mortgage insurance, or PMI, even though her home's value had increased enough that she no longer needed it. The lender never notified her. She only found out because she finally decided to scrutinize her statement, noticed the line item, and made a single phone call. That one call saved her over $150 a month. That's $1,800 a year, just for taking 30 minutes to understand a single piece of paper. That's the power we're unlocking today. So let's do this. Grab your most recent mortgage statement. If you don't have a paper copy, log into your lender's website and pull it up on your screen. We're going to walk through this together step by step, starting right at the top. The very first thing you'll see, usually in a prominent box at the top of the page, is the summary section. This is mission control. It gives you the high-level, must-know information for the current month. It seems basic, but you'd be shocked how many errors can hide in plain sight right here. Look for your loan number. This is your unique identifier with the lender. It's not your bank account number. It's the social security number for your mortgage. Anytime you call your lender, this is the first thing they'll ask for. Know where it is. Right next to it, you'll see the property address. I know it sounds ridiculous, but I want you to do this. Check it. Make sure it's 100% correct. In a world of automated systems and data entry, bizarre mix-ups can and do happen. You want to be certain you're paying the mortgage for your house. Now for the big ones. Payment due date and amount due. The due date is obvious, but let's talk about the grace period. Most U.S. mortgages have a 15-day grace period. This means if your payment is due on the 1st, you typically have until the 16th to pay it without a late fee. But, and this is a huge but, if your payment arrives on the 17th, you're not just hit with a late fee. The real damage is that after 30 days, the lender can report that late payment to the credit bureaus. A single 30-day late payment can crater your credit score by as much as 100 points, an impact that can linger for years, affecting your ability to get a car loan, a credit card, or even a better interest rate in the future. The lesson: treat the due date as sacred. The grace period is an emergency brake, not a suggestion. Okay, let's look at that amount due. This is the total cash you need to send them this month. But where does that money actually go? This is the most important question, and the answer is usually broken down right below that total. You'll see a line for principal, a line for interest, and probably a line for escrow. This is the holy trinity of your mortgage payment. Let's start with principal and interest. Together, they are the P&I of your payment. Think of your loan balance as a giant mountain of debt you have to climb down. The principal portion of your payment is the part that actually reduces the size of that mountain. It's you making progress, paying down what you actually borrowed. The interest is the cost of borrowing the money. It's the fee you pay the bank for lending you hundreds of thousands of dollars. It does not reduce your loan balance at all. Here's the kicker, especially if you're in the first few years of your loan. Look at your statement. You will see that the interest portion of your payment is massive, and the principal portion is tiny. Can feel like you're running in place. This is because of how mortgage amortization works. The bank collects most of its interest up front. So in the early years, the vast majority of your payment is just going into the bank's pocket as profit. Only a small fraction is actually chipping away at your debt. But as you continue to make payments month after month, year after year, that balance slowly shifts. The interest portion shrinks and the principal portion grows until near the end of your loan, almost your entire payment is going towards principal. Understanding this is key to understanding how you build equity and wealth over time. Now for the third piece of the puzzle, and arguably the most confusing for homeowners, escrow. If you see a line for escrow, or maybe it's labeled T&I, it means your lender is collecting extra money from you each month to pay for your property taxes and your homeowner's insurance on your behalf. They put this money into a special savings account, the escrow account, and when those big bills come due once or twice a year, the lender pays them for you out of that account. T&I stands for taxes and insurance. So your total monthly payment isn't just paying back the loan. It's also prepaying your future tax and insurance bills in small, manageable monthly chunks. This is a convenience, but it's also a major source of conflict and confusion. Because here's the thing, property taxes go up. Homeowners' insurance premiums go up. The lender has to estimate how much they'll need for the coming year. And they don't always get it right. But what happens when they get it wrong? What happens when there's a shortage in that account, and suddenly your monthly payment jumps by $200 with almost no warning? That's called an escrow shortage, and it's a shock to the system for millions of homeowners every single year. Understanding how that escrow account is calculated, how to check it for errors, and what your rights are when the lender gets it wrong is a critical skill. So let's dive right into the heart of it, the annual escrow analysis. This is the single most confusing, most anxiety-inducing document your mortgage servicer will ever send you, besides a notice of foreclosure. But once you understand it, you take back all the power. Think of the escrow analysis as your lender's annual budget meeting for your money. Once a year, they sit down and look at two things: how much money they collected from you for taxes and insurance over the past 12 months, and how much they actually paid out on your behalf. Then they do the most important part, they try to predict the future. They project what your property taxes and homeowner's insurance will cost for the next 12 months. This projection is the source of almost all the problems. Let's break down exactly how they calculate your new payment. It's a three-step process. Step 1. They estimate your total bills for the coming year. They'll look at your most recent property tax bill. Let's say it was $3,600 for the year. They'll look at your latest homeowner's insurance premium. Let's say that was $1,200 for the year. So, they project your total annual escrow expenses to be $4,800. Simple enough, right? That's $400 a month they need to collect just to pay the bills. But they don't stop there. Step 2 is where the cushion comes in. Federal law, specifically the Real Estate Settlement Procedures Act or RESPA, allows your lender to keep a buffer in your escrow account. This cushion is typically equal to 2 months' worth of escrow payments. In our example, with payments at $400 a month, the cushion would be $800. Why do they do this? It's to protect themselves and you from sudden unexpected increases. If your property taxes jump up mid-year, this cushion ensures there's enough cash in the account to cover the bill without the whole thing going into the red. So, they take the projected $4,800 for the year and add the $800 cushion. The total amount they want to have passed through that account over the next year is now $5,600. Now for step 3, the final calculation. They take that target number, $5,600, and they subtract the balance they expect to have in your escrow account at the end of the current cycle. This is where it gets tricky. Let's imagine that after they pay all your bills for this year, they project you'll have $500 left. They subtract that $500 from their target of $5,600. That leaves $5,100. That is the total amount they need to collect from you over the next 12 months. Divide that by 12, and you get your new monthly escrow payment, $425. So your new total mortgage payment would be your fixed principal and interest, plus this new $425 escrow payment. In this case, your payment went up by $25 a month. Annoying but manageable. But this is where the happy path ends and the nightmare scenario begins for millions of people. The dreaded escrow shortage. A shortage happens when the lender's projections from the previous year were too low. Let's say they projected your taxes would be $3,600, but your county reassessed property values and your actual tax bill came in at $4,800. That's a $1,200 difference. Your homeowner's insurance also went up, let's say by $200. Suddenly, the lender had to pay out $1,400 more than they planned for. They covered it for you, but now your escrow account is deep in the negative. You have a $1,400 shortage. This is where you get the shocking letter in the mail. The lender tells you two things. First, they have to correct their projection for the upcoming year. They now know your taxes are higher, so they recalculate your new monthly escrow payment based on the new, more expensive reality. Your base escrow payment is going to go up significantly just to cover the higher bills. But then comes the second punch. You still owe them for that $1,400 deficit from last year. You typically have two options. Option 1, you can write them a check for the full $1,400 right then and there. Most people can't do that. So most are forced into option 2, which is the default. The lender spreads that $1,400 shortage across your next 12 monthly payments. $1,400 divided by 12 is about $116. So now look what's happened. Your payment is going up because your future taxes are higher, and it's going up by an extra $116 a month to pay back last year's deficit. This is the escrow shortage double whammy, and it's how people see their mortgage payments jump by $200, $300, or even $500 a month overnight. It feels like a scam, but it's usually just the painful result of underprojected costs catching up with reality. On the flip side, you can have an escrow surplus. This happens when the lender collected too much. Maybe you fought your property tax assessment and got it lowered, or you switched insurance carriers and saved a bunch of money. If the analysis shows a surplus and it's over $50, the lender is required by law to send you a refund check. It's a great day when that happens. If it's under $50, they'll likely just credit it toward your next year's payments. So, how do you protect yourself? How do you fight back if you think their analysis is wrong? You have to become your own auditor. When you get that escrow analysis statement, do not just look at the new payment amount and panic. Go line by line. Find the section that shows the projected disbursements for the next year. It will list a specific dollar amount for projected county taxes or projected hazard insurance. Your mission is to verify these numbers. Don't trust them. Pull up your actual property tax bill from your county assessor's website. Does the lender's projected annual tax amount match what you actually paid last year? Or is it higher? Sometimes they use a generic area-wide percentage increase that doesn't apply to your specific home. If their projection is wildly higher than your last bill, you need to call them. Next, pull out the declarations page for your homeowner's insurance policy. This is the summary page that shows your premium for the year. Does the amount on your insurance statement match the amount the lender is projecting to pay? It's shocking how often these are mismatched. They might be using an old, higher premium from a previous year, before you switched carriers and saved money. A massive trap that snares thousands of new homeowners is the new construction shortage. When you buy a newly built home, the first year's property taxes are often based on the value of the vacant land before the house was even there. So your initial escrow payment is incredibly, deceptively low. But after that first year, the county assesses the property with your beautiful new house on it, and the tax bill can triple or quadruple. The resulting escrow shortage is gigantic. We're talking thousands, sometimes tens of thousands of dollars. If you buy new construction, you must be proactive. Find out what the taxes are on comparable, existing homes in your neighborhood and start saving extra money on your own, because that massive bill is coming. If you find a legitimate error in the analysis, if they're using the wrong tax figure or an old insurance premium, you must act immediately. Call the customer service number for your mortgage servicer. When you get someone on the phone, be calm and specific. Say, "I am reviewing my annual escrow analysis statement dated October 26th. It shows a projected property tax disbursement of $5,000. However, my most recent tax bill, which I have in front of me, was for $4,600. I need you to open a research request to correct this projection." They will likely ask you to send them proof. Be prepared to email or upload a copy of your tax bill or insurance declarations page. This is critical. You must provide documentation. Then, get a reference number for your case and ask when you can expect a response. Follow up. Be a polite but persistent squeaky wheel. Getting an escrow analysis corrected can save you hundreds of dollars on your monthly payment and prevent a manufactured crisis. You are your own best advocate. Mastering your escrow statement is about shifting from a passive homeowner who just pays the bill to an active financial manager of your single biggest asset. It's about knowing your numbers, questioning everything, and holding your lender accountable. Now that you've mastered the most volatile part of your statement, the escrow, it's time to look at the part that feels fixed but holds a powerful secret to saving tens, even hundreds of thousands of dollars over the life of your loan. We're talking about the principal and interest, and a little understood concept called amortization. Getting this wrong means you're just lighting money on fire every single month, but getting it right, that's how you build real wealth. Let's visualize your mortgage as a 30-year-long race. Your monthly payment is your race car, and inside that car are two drivers fighting for control. On one side, you have Mr. Principal. On the other, Mr. Interest. They are supposed to be a team working together to get you to the finish line, a paid-off house. But here's the secret the banks don't advertise. For the first decade of this race, Mr. Interest has his foot slammed on the gas, and Mr. Principal is tied up in the back seat. This is the reality of amortization. It's a fancy word for a very simple, and sometimes brutal concept: how your loan is paid off over time. When you look at your statement, you'll see your payment is broken down. The two most important numbers in this section are the amounts going to principal and interest. Principal is the easy one. That's the actual money you borrowed to buy the house. If you got a $400,000 loan, your principal is $400,000. This is your debt. This is the mountain you have to climb. Every single dollar that goes toward principal reduces that mountain. It's a dollar of your own house that you are buying back from the bank. It's a dollar of pure wealth creation. Interest is the flip side. Interest is the cost of borrowing the money. It's the fee you pay the bank for the privilege of using their $400,000 to live in your home. It's pure profit for them. A dollar paid in interest is a dollar that vanishes into thin air. It doesn't reduce your debt. It doesn't build your equity. It's the price of admission. Now here's where it gets wild. In the early years of your 30-year mortgage, your payment is overwhelmingly, shockingly, almost entirely interest. Let's go back to our race. For the first few years, Mr. Interest is this giant muscular beast, and Mr. Principal is a scrawny little guy. So when your monthly payment of, say, $2,500 comes in, Mr. Interest grabs about $2,000 of it, and Mr. Principal only gets the leftover $500. Think about that. You just made a $2,500 payment, but your actual loan balance, the mountain you have to climb, only shrank by $500. The other $2,000? Poof, gone. Paid to the bank as their fee for that month. This is why, for the first 5 to 7 years of a mortgage, it feels like you're running in place. You're making payments every single month, but when you look at your loan balance, it has barely budged. It's disheartening. It's frustrating. And it's by design. The bank structures the loan this way to get their profit up front, when the loan is largest and their risk is highest. But then something magical starts to happen. It's a slow, almost invisible process. Every month, that tiny $500 that Mr. Principal got, it made the mountain just a little bit smaller. So the next month, when the bank calculates the interest, they're calculating it on a slightly smaller balance. This means the interest charge for that month is a tiny bit less. Maybe it's $1,998 instead of $2,000. Because your total payment of principal and interest stays the same, that extra $2 has nowhere else to go. It has to go to Mr. Principal. So next month he gets $502. It doesn't sound like much, but the snowball has started rolling downhill. The next month the balance is even smaller, so the interest is even less, and Mr. Principal gets a little bit more. Month after month, year after year, this seesaw effect continues. Mr. Interest slowly gets smaller and weaker, and Mr. Principal gets bigger and stronger. Fast forward 15 years into your loan. You're at the halfway point. Now, when your $2,500 payment comes in, the split might be nearly 50-50. Mr. Interest takes $1,250, and Mr. Principal takes $1,250. You are now reducing your debt and building wealth at a much faster rate. The seesaw is balanced. Now let's jump to the last 5 years of your loan. The transformation is staggering. Mr. Principal is now the giant muscular beast. Mr. Interest is the scrawny little guy shoved in the back seat. That same $2,500 payment comes in, but now Mr. Principal grabs $2,200 of it, and Mr. Interest only gets a meager $300. Every single payment is now making a massive dent in your loan balance. You're not just paying off the loan. You are sprinting towards the finish line, building equity at a breathtaking pace. This is the power of amortization. So, how do you use this knowledge? First, you need to find your amortization schedule. This is the holy grail document for your mortgage. It's a complete payment-by-payment breakdown of your entire 30-year loan. It shows you exactly how much of each payment goes to principal and how much to interest for all 360 payments. Some lenders include it with your closing documents. Others you may have to request or find online in your loan portal. Get this document, print it out, look at it, understand the journey you are on. But understanding is only half the battle. The real secret is realizing you don't have to be a passive passenger in this race. You can change the outcome. You can give your driver, Mr. Principal, a secret weapon, and that weapon is making extra payments directly to principal. Let's be crystal clear about this. Any extra money you send, even $20, must be specifically designated as a principal-only payment. If you just send extra cash, the bank might just apply it to your next month's payment, which does you no good. You have to tell them, this money is only for Mr. Principal. When you do that, you perform a kind of financial magic. That extra money doesn't go to pay future interest. It bypasses Mr. Interest completely. It goes directly to shrinking the mountain. It's like taking a shortcut in the race. Let's say you decide to pay an extra $100 per month towards principal. That $100 doesn't sound like a lot on a massive mortgage. But here's what it does. By immediately reducing the loan balance, you are permanently reducing the playground that Mr. Interest gets to play on. For every single month for the rest of your loan, the amount of interest you are charged will be lower than it would have been. This means the seesaw tips in your favor faster. The snowball starts rolling bigger sooner. That extra $100 a month on a typical $400,000 mortgage at 6.5% could let you pay off your house 5.5 years early. Let me say that again. 5.5 years of freedom. But it gets better. By doing that, you would also prevent over $85,000 in interest payments from ever leaving your pocket. That's $85,000 that stays with you and your family, instead of going to the bank's bottom line. This is how you turn a mortgage from a 30-year sentence into a wealth-building machine. You take control. You understand the game. You know that in the beginning the bank wins. In the end you win. And you use extra principal payments to get to your winning phase years ahead of schedule. Look at your statement right now. Find that principal and interest breakdown. That isn't just two numbers on a page. That is the scorecard in the single most important financial race of your life. But principal and interest are only half the story. There's another, even more confusing part of your payment that most people get dangerously wrong. It's a holding account the bank controls, and it's called escrow. And what's hiding in your escrow account could be costing you thousands without you even realizing it. We're going to break that down next. So, what exactly is this escrow account? Think of it as a special savings account that you don't control. Your mortgage lender sets it up and manages it on your behalf. Every single month when you make that big mortgage payment, a portion of it isn't going towards your loan at all. Instead, the bank schemes it off the top and deposits it into this escrow account. Sits there waiting. But waiting for what? It's waiting to pay two of the most significant, and often unpredictable, costs of homeownership: your property taxes and your homeowner's insurance. Now, why would the bank do this? It sounds helpful, right? A forced savings plan to make sure you don't get hit with a massive tax bill you can't pay. And that's partly true. But let's be crystal clear about the real motivation. The bank isn't doing this out of the goodness of its heart. They're doing it to protect their investment. Your house is the collateral for their massive loan to you. If you fail to pay your property taxes, the local government, the county, or the city can put a lien on your property and, in a worst-case scenario, even foreclose on it. A tax lien takes priority over a mortgage lien, meaning the taxman gets paid before the bank does. The bank absolutely cannot let that happen. Similarly, if your house burns down and you don't have homeowner's insurance, their multi-$100,000 asset literally goes up in smoke. They are left with a worthless piece of land and a massive loan that's unlikely to be repaid. So, by forcing you into an escrow account, the bank guarantees that the two bills that could jeopardize their investment, taxes and insurance, are paid on time every time. You're essentially prepaying your future bills into an account they control, and they handle the logistics. So, let's look at those two components. First, property taxes. These are what you pay to your local government to fund public schools, police and fire departments, road maintenance, and local parks. The amount you owe is based on the assessed value of your home, multiplied by the local tax rate. The key thing to understand is that this number is not static, can and often does change every single year. Your home's value might get reassessed, or the local government might raise the tax rate to fund a new project. Second, you have homeowner's insurance, sometimes called hazard insurance. This protects you and the bank from financial loss due to disasters like fire, theft, or storms. The cost of your insurance policy, your premium, can also change annually. Maybe you filed a claim, or maybe the insurance company just decided to raise rates across the board in your area due to increased risks like wildfires or hurricanes. Here is where the danger we talked about comes into play. The bank doesn't know for sure what your taxes and insurance will be next year, so they have to estimate. Once a year, they perform what's called an escrow analysis. They take last year's total bill for taxes and insurance, maybe pad it a little bit to anticipate an increase, and then divide that total by 12. That amount is the escrow portion of your monthly mortgage payment. And this is the moment of truth, the part that causes homeowners across the country to open a letter from their bank and feel their stomach drop. It's when the bank's estimate is wrong. Let's walk through a scenario. Say your total mortgage payment is $2,500 a month. $1,500 of that is your principal and interest, and $1,000 is for escrow. You pay this amount on time for 12 straight months. Everything feels stable. Then you get a thick envelope in the mail. It's your annual escrow analysis. You open it, and the letter informs you that your new monthly mortgage payment is going to be $2,900. A $400 a month jump. How is that even possible? You panic. Did you miss a payment? Did the bank make a mistake? No. What happened is that the bank's estimate was too low. Maybe your property taxes went up by $2,000 for the year because of a new school assessment. And maybe your insurance premium went up by $400. That's a total of $2,400 in expenses that the bank paid on your behalf, but didn't collect enough money from you to cover. This is called an escrow shortage. You now owe the bank that $2,400, and they give you two options, neither of them great. You can either write them a check for the full $2,400 right now, or, and this is what most people are forced to do, they will spread that shortage out over your next 12 payments. So that $2,400 shortage, divided by 12, adds $200 to your monthly bill for the next year just to pay back the deficit. But wait, it gets worse. The bank also has to adjust your escrow payment going forward to match the new, higher costs of taxes and insurance. So your escrow payment, which was $1,000, now needs to be $200 higher to cover the new reality. That's another $200. You add the $200 for the shortage to the new $200 for the future payments, and boom, your monthly mortgage payment just went up by $400. This is the payment shock that can wreck a family's budget, and it all happens because of a bad estimate hiding inside your escrow account. Now, what about the other way around? What if the bank overestimates? This is called an escrow surplus or overage. Let's say they collected $300 a month for escrow, but your taxes and insurance only ended up costing $250 a month. At the end of the year, they've collected $600 more from you than they needed. By law, if the overage is above a certain amount, typically $50, they have to send it back to you. So one day you get a surprise check in the mail from your mortgage company for $600. Feels like free money. You celebrate. But think about what really happened. You gave your mortgage company an interest-free loan of your own money for an entire year. That $600 could have been sitting in your high-yield savings account earning interest for you. Could have been invested. It could have been used to pay down high-interest credit card debt. Instead, it was sitting in the bank's account, doing absolutely nothing for you. So while getting a check is nice, it means your monthly payment was unnecessarily high all year long. This is why you cannot afford to be passive about your escrow. You have to be proactive. When you get that annual analysis, don't just look at the new payment and sigh. Scrutinize it. Does the bank's projection for your property taxes make sense? You can usually look up your property assessment and tax rates on your county's website. Did they massively overestimate your homeowner's insurance? If so, maybe it's time to shop around for a better rate, which not only saves you money on the premium but also lowers your monthly escrow payment. You need to treat that escrow analysis not as a bill, but as a report card on your bank's ability to estimate your expenses. Understanding escrow is about pulling back the curtain on the biggest, most volatile part of your mortgage payment. It's the difference between being blindsided by a massive payment jump and being in control of your financial future. Now that we've dissected the 4 core components of PITI, principal, interest, taxes, and insurance, we can move deeper into the statement. We're going to look at the section that seems the most boring, the part that looks like a simple bank ledger from the 1980s. It's the transaction history. And while it might look like just a list of dates and numbers, this is where the real evidence is. It's the line-by-line proof of exactly where every single penny of your payment went. And hidden in that history, you might just find mysterious fees, misapplied funds, and the critical clues you need to catch mistakes before they cost you a fortune. So let's pull out the magnifying glass and become financial detectives, because the transaction history section is where the real story of your mortgage is written, month by month, dollar by dollar. This isn't just a boring list of dates and numbers. It's the official record, the ledger that can either prove your lender is doing everything right, or reveal the costly errors that are silently draining your wealth. At first glance, it seems simple enough. You'll see columns, usually with labels like transaction date, posting date, description, and amount. Now, the first 2, transaction date and posting date, might seem identical, but the difference between them can be the very reason you get hit with an unjust late fee. The transaction date is typically the day the lender receives your payment or initiates an action. The posting date is the day they officially apply it to your account. Think of it like depositing a check. You might drop it at the bank on a Friday afternoon. That's the transaction date. But it might not actually clear and post to your account until Monday. For your mortgage, if your payment is due on the 1st and you have a 15-day grace period, a payment received on the 15th is on time. But if their internal process is slow and they don't post it until the 17th, a poorly designed automated system might wrongly flag you as late. Knowing this distinction is your first piece of evidence. If you ever have to fight a late fee, the transaction date or date received is your proof. But the real drama unfolds in the description column. This is the narrative. This is where you see exactly what happened. You'll see familiar terms, payment received, followed by a breakdown of how that payment was sliced up. You'll see lines for principal, interest, and escrow. Every single month you should see these. Your payment comes in as one lump sum, and then the lender system immediately performs surgery, sending one amount to pay down your loan balance, another to the bank's profits as interest, and the third piece into your escrow holding account. Let's follow the money with a hypothetical couple, the Jacksons. In May, they make their standard payment of $2,200. Their transaction history shows payment received, plus $200. Then immediately below it, 3 more lines appear. Interest, minus $1,400. Principal, minus $350. Escrow, minus $450. Notice the negative signs. That's the money being applied or subtracted from the lump sum they received. The Jacksons can see that only $350 of their $2,200 payment actually went towards owning more of their home. It's a sobering reality, but it's crystal clear. Now, here's where the detective work begins. In June, the Jacksons get a small bonus and decide to be proactive. They want to pay down their mortgage faster, so they add an extra $500 to their payment, sending in a check for $2,700. They feel great about it. They're hacking away at their debt. But when they get their next statement, they look at the transaction history and their hearts sink. They see payment received, plus $2,700. Good. Then they see the usual breakdown. Interest, minus $1,398. Principal, minus $352. Escrow, minus $450. Wait a minute. The principal payment only went up by $2. Where did their extra $500 go? They scan further down the list of transactions and find a mysterious line item. Funds to unapplied balance, plus $500. This is one of the most common and infuriating traps in the mortgage world. The unapplied balance or suspense account is a kind of financial purgatory. The lender has your money, but they haven't applied it to your loan balance. Why? Sometimes it's because the extra amount wasn't enough to make a full, additional monthly payment. Other times it's because you didn't explicitly instruct them, in the exact way their system requires, that the extra funds were for principal reduction only. So the Jacksons' $500 is just sitting there, in limbo. It's not earning them interest, and more importantly, it's not reducing their principal balance. This means they are still paying mortgage interest on a loan balance that should be $500 smaller. It's a subtle but significant financial injury. They've lost the entire benefit of paying extra. Without scrutinizing the transaction history, they might have gone on for months, even years, throwing extra money into this black hole, thinking they were being smart, when in reality their lender was just holding their cash. The solution? They needed to either use their lender's online portal, which usually has a specific box to check for additional principal payment, or include a separate, clearly marked note with their check. The transaction history is also where you hunt for bogus fees. You might see a charge for property inspection fee for $25. This can be legitimate if, for example, your homeowner's insurance lapsed, and the lender sent someone to verify the property wasn't abandoned or damaged. But if your insurance has always been active, this is a mistake. It's a fee you shouldn't have to pay, but it will be automatically deducted from your next payment unless you spot it and challenge it. You might also find corporate advance or lender-placed charges. These are huge red flags. A corporate advance means the lender paid for something on your behalf that they believe you were responsible for, and now they're billing you for it, plus administrative fees. Most often, this is related to lender-placed insurance, also called force-placed insurance. This happens if the lender believes you let your homeowner's insurance policy expire. They will then buy a new policy for you, a policy that is almost always astronomically more expensive than what you could get on your own, and it only protects their interest, not your belongings. If you see this on your statement, you need to call your lender and your insurance agent immediately, because it means there's a serious and very expensive miscommunication happening. Finally, the transaction history is your only way to verify that the most important job you pay your lender to do is actually getting done, paying your taxes and insurance from escrow. Twice a year, or sometimes quarterly, you should see a massive withdrawal from your account. The description will be something like escrow disbursement, county property tax, or escrow disbursement, hazard insurance premium. The amount will be large, likely several $1,000s. Your job is not just to see that the money went out. Your job is to pick up the phone or go online and confirm with your county tax office and your insurance company that they actually received the payment and that they received it on time. A lender failing to pay your taxes on time can result in penalties and liens against your property. A lender failing to pay your insurance on time could leave your home unprotected. You are paying for this service. The transaction history is your tool to audit them and ensure they're not failing you. It's the ultimate accountability checklist. By now, you can see that this section of your statement is anything but a simple receipt. It's the DNA of your loan. It's the proof, the evidence, the complete story of your financial relationship with your lender. Learning to read it is like learning a new language, the language of financial self-defense. You now know how to spot misapplied payments, hunt down phantom fees, and verify your escrow disbursements. But all of this, every transaction, every payment, every fee, is leading up to one of the most important, and often most dreaded, documents a homeowner receives, the annual escrow analysis. This single document is the reason your fixed-rate mortgage payment can suddenly and dramatically change. It's the lender's yearly prediction of the future, where they look into their crystal ball of property taxes and insurance premiums and decide if you've paid them enough, or if you owe them more. This analysis is where terms like shortage, surplus, and deficiency come into play, and understanding them is the key to predicting and preparing for a massive payment shock that catches millions of homeowners by surprise every single year. Let's imagine it's a Tuesday afternoon. You get home, sort through the mail, and there it is. An official-looking envelope from your mortgage company. It's not the usual bill. It's thicker. You open it, and your eyes scan past the corporate logo and legal jargon, landing on a single horrifying number. Your new monthly mortgage payment. It's gone up. Not by $20 or $30. It's jumped by $200, $300, maybe even $500. Your stomach drops. You feel a wave of panic, then anger. How is this possible? Your interest rate is fixed. Did they make a mistake? Are they trying to scam you? This exact moment is the payment shock we're talking about. And it almost always originates from one place: That annual escrow analysis statement you're holding in your trembling hands. This document isn't a mistake, it's a reckoning. It's your lender looking back at the last 12 months and looking forward to the next 12, and realizing the numbers no longer add up. To understand this, you have to think of your escrow account like a simple checking account that you're not allowed to touch. Every month, you deposit a set amount, your escrow payment. A couple of times a year, your lender makes a huge withdrawal to pay your property taxes and your homeowner's insurance premium. The goal is simple. Make sure there's always enough money in the account to pay those bills when they come due. But here's the catch. The lender has to guess how much those bills will be a year in advance. They base their guess on what you paid last year. And in today's world, that's an increasingly dangerous guess. Property taxes are rising in most of the country. Insurance premiums, especially in areas prone to floods, fires, or hurricanes, are skyrocketing. So, what the lender thought you needed to save for the year often falls short of what they actually had to pay out on your behalf. This is where the escrow analysis begins. The lender projects your escrow account balance for the next 12 months, month by month. They map out all your planned deposits and all their anticipated withdrawals for taxes and insurance. During this projection, they are looking for one critical thing: the lowest point your account balance will hit over the course of the year. By federal law, specifically the Real Estate Settlement Procedures Act or RESPA, your lender is allowed to require you to keep a minimum balance in your escrow account. This is a safety net, a cushion. This cushion is typically equal to 2 months' worth of escrow payments. So if you pay $400 a month into escrow, your lender can require that your account balance never, ever drops below $800 at its lowest point during the year. Now let's connect this to that letter that ruined your Tuesday. The analysis revealed a problem, and that problem has a name. Most likely, it's a shortage. An escrow shortage occurs when the lender's projection shows that your account balance, at its lowest point, will dip below the required 2-month cushion, but it will not go below zero. Let's use an example. Say your required 2-month cushion is $800. Last year, your property taxes unexpectedly went up by $600. The lender paid it. They used your regular escrow funds, and then they had to dip into that $800 cushion to cover the rest. The bill got paid, your account never went negative, but at its lowest point, the balance was only $200. That's a problem. You have a shortage because you failed to maintain the required $800 minimum balance. You were short by $600. But there's a more severe problem called a deficiency. This is the one that causes the biggest payment shocks. A deficiency happens when your taxes or insurance go up so dramatically that the lender has to pay out more money than was even in your account to begin with. They paid your bill, but to do so they had to advance their own money, driving your escrow account balance into negative territory. If your account held $3,000 and a surprise $3,500 tax bill arrived, the lender paid it, and your escrow balance is now negative $500. Not only have you blown through your 2-month cushion, you're now in the hole. That negative balance is your deficiency. So the lender looks at this situation. They see a shortage or a deficiency. They cannot let this continue. They have to fix it. And their fix involves 2 punishing steps that combine to create your payment shock. Step 1 is recalculating your base payment. The party's over. They now know that your taxes and insurance are higher. They can't keep collecting the old lower amount. So they take the new actual cost of your annual tax and insurance bills, divide it by 12, and that becomes your new monthly escrow payment going forward. If your total escrow bills went up by $1,200 for the year, your monthly payment has to go up by $100, effective immediately. That's the first part of the increase. But what about the shortage? What about that $600 hole you created in your cushion? You have to pay that back. The lender typically gives you 2 options. Option A. You can write them a check for the full $600 shortage right now. This is called a lump sum payment. Most people can't or don't want to do this, so they are defaulted into option B. The lender will spread that $600 shortage out over your next 12 mortgage payments. $600 divided by 12 is an extra $50 per month. Now let's put it all together. Your payment is already going up by $100 a month to cover the actual higher cost of your future bills. On top of that, you're paying another $50 a month to repay the shortage from last year. Your total monthly mortgage payment has just jumped by $150. And that was for a relatively small shortage. Imagine if you had a $2,400 deficiency. Your base payment would go up to cover the new costs, plus you'd have to repay that $2,400 over 12 months. That's an extra $200 a month right there just to pay back the deficit. This is how a payment can suddenly balloon by hundreds and hundreds of dollars. It's a brutal combination of paying for next year's higher costs, while also paying back last year's shortfall. Of course, there is a third, much happier possibility: a surplus. A surplus is the opposite of a shortage. It means your lender overestimated your expenses. Maybe you fought your property tax assessment and won, and your bill went down. Or you shopped around for homeowners insurance and found a cheaper policy. At the end of the year, after paying all the bills and accounting for your 2-month cushion, there's extra money left over. If that surplus is $50 or more, your lender is legally required to cut you a check and mail it to you. It's a fantastic feeling, like finding money in a winter coat. They will still adjust your monthly payment downwards for the coming year to reflect your lower costs, but you also get a nice little windfall. But for the millions facing a shortage or deficiency, that letter doesn't bring a windfall. It brings a wave of anxiety. You're staring at this new, higher payment and feeling trapped. It's crucial to understand this isn't your lender being greedy. They aren't making any extra money from your escrow account. They are simply acting as a middleman, collecting money from you and passing it directly to your local tax authority and insurance company. The payment increase is a direct pass-through of rising costs in your community. Your lender is just the messenger, and the escrow analysis is the message. But being the messenger doesn't mean they're infallible. Their calculations, their projections, the data they receive from your tax office, it can all contain errors. They might have you down for the wrong tax rate. They might not have received the notice that you switched to a cheaper insurance provider. They might just make a simple clerical error. And these errors can cost you thousands, which means you can't just passively accept that payment shock. You have to scrutinize that statement. You have to know what you're looking for, question the numbers, and be prepared to challenge them. Because buried in those columns and projections could be a mistake that is costing you a fortune, and it's up to you to find it. And finding it begins with knowing where to look. Your mortgage statement isn't just a bill. It's a crime scene, and you are the lead detective. The culprits are errors, and they hide in plain sight, disguised as legitimate charges. So let's equip you with your detective's magnifying glass and show you the 3 most common places these financial criminals love to hide. The first, and by far the most frequent, is the escrow account analysis. This is the place where honest mistakes and lazy accounting can cost you hundreds, even thousands of dollars a year. Remember, your escrow account is a holding tank for your property taxes and homeowners insurance. The lender estimates how much these will be for the year, divides it by 12, and adds it to your monthly payment. The problem is, it's an estimate, and when that estimate is wrong, chaos ensues. Let's say your property taxes go up. The county reassesses your home's value, and suddenly your tax bill is $500 higher for the year. Your lender pays it from your escrow account, but now your account is short. It has a deficit. To fix this, the lender does 2 things. First, they increase your monthly escrow payment for the next year to account for the new, higher tax bill. That part makes sense. But second, they also have to make up for the $500 shortage from this year. They can either ask you for a lump sum payment, or more commonly, they'll spread that shortage over the next 12 months and add that to your payment as well. This is where the sticker shock happens. Your payment doesn't just go up by $42 to cover the new taxes. It goes up by another $42 to cover the old shortage. Suddenly, your mortgage payment has jumped by nearly $100 a month, and you're left wondering what happened. The error isn't necessarily that they adjusted it. The error is often in how they calculated it. They might overestimate the next year's taxes, creating an unnecessary surplus that they get to hold on to interest-free. They might miscalculate the shortage. They might even be using old tax data. Your mission is to verify their math. Don't just accept a payment increase. Demand a copy of the full escrow account analysis. It's a detailed breakdown of every dollar in and every dollar out. Cross-reference the property tax amount they used with the actual bill from your county assessor's office. Call your insurance agent and confirm the premium they have on file. If the numbers don't match, you've found your first clue. Lenders are notorious for overpadding these accounts. It's your money. Make sure their projections are based on reality, not on their desire for a bigger cushion. The second hiding spot is more sinister because it attacks the very core of your loan: the interest rate. This is especially critical for homeowners with an adjustable rate mortgage, or ARM. These loans have an interest rate that changes over time based on a specific financial index. The rules for how and when that rate can change are spelled out in excruciating detail in your original loan documents. But do you think the person in a cubicle responsible for adjusting thousands of loans a month reads every single one? Of course not. They use a computer program, and sometimes that program is wrong. The index might be applied incorrectly. The margin, the percentage points the lender adds to the index, might be wrong. The caps, which limit how much your rate can increase at one time or over the life of the loan, might be completely ignored. A 0.5% error on a $300,000 loan is over $100 a month every single month, until you catch it. Over years, it's a fortune. Even with a fixed-rate mortgage, you're not entirely safe. Clerical errors happen. Maybe your loan was supposed to be at 6.25%, but someone typed in 6.5% when setting up your account. You'd be paying thousands extra over the life of the loan based on a simple typo. So what do? You pull out your original closing disclosure. Find the section that details your interest rate. If it's fixed, does it match the rate on your current statement? If it's an ARM, do the details about the index, the margin, and the adjustment caps match what the lender is using? If there's any discrepancy, you've found a critical piece of evidence. The third major culprit is the misapplication of payments, especially extra payments. Millions of savvy homeowners try to pay down their mortgage faster by sending in a little extra money each month, or making a lump sum payment when they get a bonus. Their goal is to have that extra cash applied directly to the principal balance. This reduces the loan amount, which means you pay less in interest over time, and you own your home sooner. It's one of the smartest financial moves you can make, but it only works if the lender does it correctly. Too often, lenders will take your extra payment and dump it into something called a suspense or unapplied funds account. There it sits doing nothing. It's not paying down your principal. It's not reducing your interest. It's just waiting. Sometimes they'll hold it there until it accumulates to the amount of a full monthly payment, and then they'll apply it to your next month's payment, essentially just paying you ahead. That's not what you wanted. You wanted it to attack the principal. Now, look at your statement carefully. There should be a line item showing exactly how your payment was broken down. How much went to principal, how much to interest, and how much to escrow. If you sent in an extra $100, you should see the principal portion of that payment increase by $100. If you instead see a line item that says unapplied funds or suspense account balance, a red flag should go up. They've taken your money but haven't used it to your benefit. This is your money, your equity, being held hostage by an accounting error. So you've done your detective work. You've reviewed your escrow, checked your interest rate, and tracked your extra payments. And you've found something. A number that doesn't add up. A charge that makes no sense. What now? This is where most people stop. They feel intimidated. But this is precisely where you must act. Step 1. Gather your evidence. Assemble a file. This includes your original loan documents, your closing disclosure, the last 12 months of your mortgage statements, and any proof you have, like a copy of your actual tax bill or a canceled check showing an extra payment. Step 2. Make the call. Find the customer service number on your statement. When you get a representative on the phone, be calm, be professional, but be firm. Do not say, "I think my bill is wrong." Say, "I am calling to discuss a specific error on my statement for the month of August. My loan number is X. According to my closing disclosure, my interest rate should be 5.75%, but you have charged me at 6%. I have the document in front of me. I need this corrected, and I need my account credited for all past overages." Be specific. Refer to your evidence. At the end of the call, get the representative's name, a reference number for your case, and a clear timeline for when you can expect a resolution. Step 3, and this is the most important step of all. Formalize your dispute in writing. This isn't just a letter. It's a powerful legal tool defined by federal law. It's called a Qualified Written Request, or QWR. Under the Real Estate Settlement Procedures Act (RESPA), when a lender receives a QWR, they are legally obligated to acknowledge it within 5 business days and provide a substantive response within 30 business days. They can't just ignore you. Your QWR should include your name, address, and loan number. It must clearly state that you believe there is an error on your account and explain, with as much detail as possible, what the error is and why you believe it's wrong. Attach copies, never the originals, of your supporting documents. Send this letter via certified mail with a return receipt requested. That receipt is your legal proof that they received it. This single action transforms you from just another customer on the phone to a consumer exercising their federal rights. And the mortgage company now has a legal clock ticking. They have to investigate, and they have to give you a written explanation. This is how you move from being a victim of an error to being the agent of your own financial defense. And now that you're armed with the tools for defense, let's switch to offense. Let's talk about how to use your mortgage statement not just to protect yourself, but to actively attack and eliminate the unnecessary costs that are draining your wealth month after month. And we're going to start with the single most hated line item on any mortgage statement: PMI, private mortgage insurance. Think of PMI as an unwanted house guest. You didn't invite them, they live in your house, you have to pay for their food, and they offer you absolutely nothing in return. Because let's be crystal clear, PMI does not protect you. It protects your lender. It's an insurance policy that you are forced to pay for, that covers the bank in case you default on your loan. It's the fee you pay for the privilege of putting down less than 20% when you bought your home. And for millions of Americans, it's $100, $200, even $300 a month that feels like setting cash on fire. But here's the good news. This house guest can be kicked out. You don't have to live with them for the entire 30 years of your mortgage. The Federal Homeowners Protection Act gives you a legal right to evict them. But there are two ways to do it: the slow way and the fast way. The bank wants you to take the slow way. We're going to focus on the fast way. The slow way is called automatic termination. The law states that once your loan-to-value ratio, or LTV, reaches 78% of your home's original value, your lender must automatically terminate your PMI. The original value is usually the purchase price or the appraised value when you first got the loan, whichever was lower. So if you bought a $400,000 house, your PMI has to, by law, disappear once your loan balance drops to $312,000. This happens eventually just by you making your regular payments. It's passive. It requires no action. And it can take 7, 8, even 10 years depending on your loan. This is the path of least resistance, and it costs you thousands of dollars in unnecessary payments while you wait. But there is a much, much better way. The fast way. This is called borrower-requested cancellation. The same law gives you the right to request that your PMI be canceled once your loan-to-value ratio hits 80%. Now you might be thinking, 80%? 78%? What's the big deal? It's only a 2% difference. And if we were only talking about the original value of your home, you'd be right. But this is where the secret lies. This is the key that can unlock thousands of dollars in savings for you, years ahead of schedule. Your request to cancel PMI can be based on the current market value of your home. Let that sink in for a moment. Not the price you paid 5 years ago, the value of your home today. In most real estate markets across the United States, home values have skyrocketed over the past several years. Your house is likely worth significantly more now than when you bought it. And that appreciation is your golden ticket to getting rid of PMI. Let's run the numbers because this is where it gets exciting. Let's go back to that $400,000 house. Let's say you put 10% down, so $40,000. Your original loan was for $360,000. To get to the 80% LTV mark based on the original value, you'd need to pay your loan down to $320,000. That's $40,000 in principal payments. At the beginning of a mortgage, most of your payment goes to interest, so this could take you over 7 years. For 7 years, you're paying, let's say, $150 a month in PMI. That's over $12,000 gone forever. But what if, after just 2 years, the housing market in your area has boomed? You've been making your payments and your loan balance is now down to, let's say, $350,000. But you look around and houses like yours are now selling for $500,000. Your home's value has appreciated by $100,000. Now let's recalculate your loan-to-value ratio using the new number. Your loan is $350,000. Your home's value is $500,000. You divide the loan by the value. $350,000 divided by $500,000 is 0.70. That's a 70% LTV. You didn't just cross the 80% threshold to request cancellation. You blew right past it. You are potentially eligible to cancel your PMI right now, not 5 or 6 years from now. Today. And that $150 a month you were lighting on fire can go straight into your pocket, or better yet, towards your principal. So, how do you actually do this? It's a simple 4-step process. Step 1. Find your current principal balance. It's right there on your mortgage statement, the number we've been dissecting this whole time. Step 2. Get an estimate of your home's current market value. You can use online estimators like Zillow or Redfin for a ballpark idea. Just be conservative. If they say $500,000, maybe think $490,000 in your head. This isn't for the bank. This is just for you to know if you're in the right ballpark to even make the call. Step 3. This is the most important step. Call your mortgage servicer. The phone number is on your statement. You're going to use a specific set of words. You're going to say, "I would like to request information on the process for canceling my private mortgage insurance based on my home's current, appreciated value." They do this all day long. They have a department for it. They will tell you their exact procedure. Step 4. Follow their process to the letter. They will almost certainly require a formal appraisal to verify your home's new value. Yes, you will have to pay for this appraisal out of pocket. It might cost you $400, $500, maybe $600. Do not let this stop you. This is not a cost. It is an investment with an insane return. Would you pay $600 one time to save $150 every single month for the next 5 years? That's a $9,000 savings on a $600 investment. You make that trade every single time. You'll get the appraisal, submit the paperwork they require, and then you follow up until you see that PMI charge disappear from your monthly statement. Now, a couple of quick but critical caveats. First, some lenders have what's called a seasoning requirement. They might require you to have the loan for a minimum period, often 2 years, before they'll consider a cancellation based on appreciation. So if you just bought your house 6 months ago, you might have to wait a bit. Second, and this is hugely important, if you have an FHA loan, the rules are completely different and much stricter. For most FHA loans taken out after 2013, the version of mortgage insurance called MIP or mortgage insurance premium is for the entire life of the loan. It never goes away automatically. The only way to get rid of it is to refinance into a conventional loan once you have enough equity. So if you see FHA anywhere on your loan documents, your path is refinancing, not requesting cancellation. For everyone else with a conventional loan, this is one of the most powerful financial moves a homeowner can make. You are taking control. You're leveraging an asset, your home's increased value, to cut your monthly expenses permanently. You're not waiting for the bank to do you a favor. You're enforcing your rights under federal law. You've learned how to defend yourself against errors, and now you know how to go on offense to slay the monthly dragon of PMI. But that's just one line item. What about the biggest, most intimidating number on the entire statement? The total interest you're scheduled to pay over 30 years. That $500,000 number that feels like a life sentence. Well, it's not. In the next part, we're going to turn your mortgage statement into a weapon, a tool you can use to systematically demolish your principal balance and pay off your house years, even a decade or more ahead of schedule, saving you tens or even hundreds of thousands of dollars in interest. The path to becoming completely mortgage-free is hidden in plain sight, right there in the numbers on your statement. So how do we actually use this document, this simple piece of paper that arrives every month, to unlock that future? It starts by understanding one of the most powerful financial concepts you will ever encounter: the strategic application of extra principal payments. It sounds complicated, but it's astonishingly simple. Every single dollar you pay over your required minimum, if applied correctly, goes directly to chipping away at that massive principal balance. It doesn't pay future interest, it doesn't go into a holding account. It goes toward directly against the debt itself. And because interest is calculated on your remaining principal, every dollar you pay down today saves you from paying interest on that dollar for the rest of your loan's life, potentially for the next 30 years. Let's talk strategy. The first and perhaps most popular method is the bi-weekly payment plan. You may have heard of this. Instead of making one monthly payment, you make a half payment every 2 weeks. The math is simple but profound. There are 52 weeks in a year, which means you'll make 26 half payments. 26 half payments equals 13 full monthly payments. By doing nothing more than changing the timing of your payments, you seamlessly make one entire extra mortgage payment every single year. Now, a word of caution here. Many third-party companies will offer to set this up for you for a fee. You do not need them. You can accomplish the exact same thing for free. Simply take your monthly mortgage payment, divide it by 12, and add that amount to your payment each month. Or just write a separate check for one full payment once a year. The result is identical. Your mortgage statement is your report card for this strategy. If you start doing this, you should see the additional principal line item reflect that extra amount, and more importantly, you will see your ending principal balance decrease at a noticeably faster rate month after month, year after year. That one extra payment a year on a typical 30-year mortgage can shave off around 6 to 8 years from your loan term. Think about that. 8 years of freedom just by making a simple automated change. The second strategy is what I call the found money approach. This is for those who don't want the rigidity of a bi-weekly plan. It's about being intentional with any extra cash that comes your way. Did you get a small raise at work? Don't just let it get absorbed into your lifestyle. Take half of that new monthly amount, say an extra $100, and apply it directly to your mortgage principal every single month. $100 might not sound like much. It's a few fancy coffees, a dinner out, but against your mortgage, it's a giant. On a $300,000 loan with a 6% interest rate, an extra $100 a month, starting from day one, would save you over $64,000 in interest and allow you to pay off your home almost 5 years early. Your mortgage statement becomes a game. Every month you send that extra $100, you can pull up your statement, look at the amortization schedule your lender provides online, and see the tangible proof of how you are literally buying back years of your life. The third strategy is the lump sum attack. This is when you get a significant windfall, a work bonus, a tax refund, an inheritance. The temptation is to spend it. A vacation, a new car. But imagine taking a $5,000 bonus and applying it directly to your principal. On that same $300,000 loan, a single one-time $5,000 principal payment in the first year could save you over $16,000 in interest and shorten your loan by more than a year. It's like a time machine for your finances. But here is where we need to get into the critical details, the things most people miss. When you make any extra payment, whether it's $50 or $5,000, you must explicitly designate it as a principal-only payment. This is non-negotiable. If you just send extra money, the lender might apply it to your next month's payment, essentially just paying your bill in advance. This does you almost no good. You want that money to reduce the loan balance now. When you pay online, there is almost always a separate box to enter an additional principal amount. If you're mailing a check, write your loan number on a separate check and write for principal only in the memo line. Then check your next statement like a hawk. Verify that the extra payment was posted correctly under the additional principal line. Trust but verify. Your statement is your receipt of proof. Now let's say you do make a large payment. What happens next? This leads to a crucial and often misunderstood concept: recasting your mortgage. When you pay down a large chunk of your principal, you have two options. By default, your monthly payment of principal and interest will stay the same, but you'll just pay off the loan much faster. However, you can also ask your lender to recast or re-amortize the loan. For a small fee, usually a few $100s, they will recalculate your monthly payment based on the new, lower principal balance, while keeping the same loan end date. This results in a lower monthly payment, freeing up cash flow. This is not the same as refinancing. Refinancing is taking out an entirely new loan, with new closing costs, a new interest rate, and a full credit check. Recasting is just adjusting the math on your existing loan. Your statement is the key. If you recast, your next statement will show the same interest rate, but the principal and interest portion of your payment will be permanently lower. It's a powerful tool for those who want more financial flexibility each month. Before you get too excited and start sending all your extra cash to your lender, we have to address the big flashing warning signs, the potential pitfalls. First, and most importantly, prepayment penalties. While they are much rarer today, especially on conventional loans, some mortgages still have a clause that penalizes you for paying off a large portion of your loan, or the entire loan within the first few years. You absolutely must know if you have one. Where do you find this information? It's in your original closing documents, often called the closing disclosure, or the loan note itself. If you can't find it, call your lender and ask them directly. Does my loan have a prepayment penalty? Get a clear yes or no. Paying a penalty could wipe out the interest savings you were trying to achieve. Second, as we've stressed, is the misapplication of funds. I cannot say this enough. Always designate extra payments for principal. Don't assume your lender will do it for you. They are a business. Their default is often to operate in the way that is most profitable for them, not you. Your statement is your only line of defense to ensure your money went where you intended it to go. And finally, the most strategic question of all. Should you even pay extra on your mortgage? This might sound like a crazy question after everything we've just discussed, but it's a vital one. It comes down to opportunity cost. Your mortgage might have a 4% interest rate. But what if you have credit card debt at 22%? Or a personal loan at 11%? Financially, every extra dollar you have should be a heat-seeking missile aimed at your highest interest rate debt first. Paying off a 22% credit card is like getting a guaranteed 22% return on your money. Your 4% mortgage can wait. Furthermore, consider investing. If you have a low-interest mortgage, say 3.5%, and you have a long time horizon, it's historically probable that you could earn a much higher return by investing that extra money in a low-cost index fund within a retirement account like a 401k or Roth IRA. It's a personal decision based on your risk tolerance. Paying off your mortgage is a guaranteed risk-free return equal to your interest rate. Investing offers the potential for higher returns, but comes with risk. There is no single right answer, but you must be aware of the choice you are making. Your mortgage statement gives you the hard number, the interest rate, that you need to weigh against all your other financial opportunities and obligations. It provides the context for making one of the most important financial decisions of your life. By mastering these strategies and being aware of the pitfalls, you transform from a passive debtor into an active manager of your largest liability. You now have the playbook to not just understand your statement, but to weaponize it in your favor. But what happens when you actually succeed? What is the final step to ensuring the house is truly, legally, and completely yours? And what are the silent mistakes people make in the final years of their loan that can cost them dearly? That final mile of the marathon is where we're headed next. The final mile. This is where champions are made, and it's also where the exhausted can stumble just before the finish line. The biggest mistake people make in the final years of their mortgage is complacency. After decades of diligent payments, it feels like the loan is on autopilot, coasting toward a zero balance. But your financial world doesn't stand still. Your property taxes can increase. Your homeowner's insurance premiums can rise. And if you have an escrow account, these changes create a silent, growing shortfall. Imagine you have just 2 payments left. You've circled the date on the calendar, planned the party, and you can practically taste the freedom. You send in your second-to-last payment, and then the final statement arrives. But instead of the small, triumphant number you expected, the final payment is $1,000 higher than you planned. Why? Because your property taxes went up 8 months ago. Your lender covered the escrow shortage as required, but now at the very end they're collecting the difference. The party is postponed. The celebration is muted by frustration. This isn't a rare occurrence. It's a common pitfall for those who stop scrutinizing their statements in the home stretch. Stay vigilant right to the very end. Now let's talk about that final glorious payment. You cannot, I repeat, cannot simply look at the principal balance on your last regular statement and write a check for that amount. If you do, you will come up short. The reason is a little thing called per diem interest. Interest on your massive loan accrues every single day. Your regular monthly statement only calculates it up to a certain point in the cycle. To truly kill the beast, you need the final exact number calculated down to the penny for a specific day. This requires you to formally contact your lender and request an official payoff quote or payoff statement. This is a legally binding document that states the exact amount of money required to satisfy the loan on a specific date. It will show your remaining principal, any interest that will accrue between now and the payoff date, and potentially a small recording fee that the lender pays to the county to officially clear their lien. The quote will have an expiration date, often called a good-through date. You must deliver the funds on or before that date. If you're a day late, the quote is invalid because another day's worth of interest has been added. When you have that magic number, do not use your regular online bill pay. Do not mail a personal check. The stakes are too high. Go to your bank and get a cashier's check, or even better, arrange for a wire transfer directly to the lender. These are certified funds. They are guaranteed. It's the financial equivalent of a walk-off home run. Once the funds are sent, call your lender a day or 2 later to confirm they've received it and that your loan balance is officially zero. And then you breathe. The weight is gone. The single largest debt of your life has been vanquished. You pop the champagne. You burn the mortgage statement in a ceremonial bonfire. You've done it. But I'm here to tell you the job is not finished. Making the final payment is just closing one chapter. Ensuring the house is truly legally yours for the rest of your life requires opening another. And what you do in the next 90 days is arguably more important than the final payment itself. The first and most critical step is securing the release of lien. When you first got your mortgage, the lender placed a legal claim or a lien on your property's title. This is their insurance policy. It says, if this person stops paying, we have the right to seize and sell this house. Now that you've paid them back, they are legally obligated to release that claim. This is done via a legal document. Depending on your state, it might be called a certificate of satisfaction, deed of reconveyance, or a release of mortgage. Your lender will prepare this document and, in most cases, they are supposed to file it with your county recorder of deeds office. This filing officially scrubs their claim from your property's public record, giving you a free and clear title. But here's the terrifying truth. Sometimes they don't. Lenders merge, paperwork gets lost, administrative errors happen. It is your responsibility to follow up and ensure this has been done. About 60 to 90 days after your final payment, you should receive a copy of the recorded release document from your lender or directly from the county. If you don't, you get on the phone. You call your lender. You call your county recorder's office. You do not rest until you have that piece of paper in your hand, complete with a stamp or seal from the county showing it has been officially recorded. Why is this so important? Because an unreleased lien is a ticking time bomb on your title. Years from now, you might try to sell your home or take out a home equity loan for a renovation or a child's college education. The title search company will pull the records and see an active lien from a bank you paid off a decade ago. The sale will halt, the loan will be denied, and you'll be thrust into a bureaucratic nightmare, trying to track down a defunct mortgage company to get a simple signature, all while your financial plans crumble. Verify the lien release. It's the true legal act that makes the house yours. Next, a simple but crucial housekeeping task. Cancel your automatic payments. If you had your mortgage payment on autopay, your bank doesn't automatically know the loan is gone. Go into your account and manually delete the recurring payment schedule immediately. You don't want an extra payment to be drafted, creating a hassle of getting your money back. Now for the fun part. Remember that escrow account you've been paying into for years? There's almost certainly money left in it. Your lender is required by law to refund you any surplus in your escrow account within a few weeks of the loan being paid off. So watch your mailbox. A check for a few hundred or even a few $1,000s should be heading your way. That's your money coming home. But this leads us to the final silent responsibility that now falls squarely on your shoulders. For years, your lender has been your financial butler. They took your escrow money and dutifully paid your property taxes and your homeowner's insurance premiums for you. That butler has now retired. You are in charge. You must immediately contact your homeowner's insurance company. Let them know that your mortgage has been satisfied. They will need to remove the lender as an interested party or lost payee from your policy. More importantly, you need to arrange to pay the premiums directly. The bills will now come to you. If you forget, your policy could lapse, leaving your single biggest asset completely uninsured against fire, theft, or disaster. Simultaneously, you must contact your county or municipal tax assessor's office. Inform them that the mortgage is paid off and that property tax bills should now be sent directly to you. Verify they have your correct mailing address. Missing a tax bill is not an excuse. If you don't pay your property taxes, the county can place a lien on your home and eventually foreclose on you. Even if you don't have a mortgage, you have transitioned from a debtor to a sovereign. You have traded a single simple mortgage payment for two separate critical responsibilities you must now manage yourself forever. Set up reminders. Budget for these expenses. This is the reality of true, unencumbered homeownership. And that is the journey. From the confusing flurry of numbers on your very first statement to the profound legal and financial steps after your very last. You've learned to decode the language of amortization, to understand the power of principal, to master the mechanics of escrow, and to navigate the final critical steps to true ownership. This piece of paper is no longer a source of anxiety, but a roadmap you have mastered. You are now in control. You are not just living in a house. You own your home, a physical anchor in the world that is completely and totally yours. It's a feeling of security and accomplishment that few things in life can match. This journey through decades of payments and careful attention was not just about paying off a loan. It was about building a foundation for your family, for your future, for your legacy. Congratulations on making it to the finish line.